Let's continue our video lecture for chapter number 9. This is part 2 of chapter number 9, where we're going to be allocating our partnership income and deductions between two different groups. One group is called ordinary business income or loss, and the other is called separately stated items. The ordinary business income or loss is usually the main operations of your partnership. Typically the selling of your merchandise or the selling of your services. And the miscellaneous income of your partnership and certain deductions are going to be separated out from that ordinary business income or deduction. And the reason for this is that certain types of income and certain types of deductions are treated differently, not here at the partnership level, but at the partner level. So we have to communicate these amounts to the partners. So that's why we break it out separately here. One of the main examples of a separately stated item is the treatment of long-term capital gains and qualified dividends. As we had learned in a previous tax course or a previous chapter within our course, is that these items get taxed at lower rates, like either tax-free, 0, or possibly for most people 15%, or for wealthier taxpayers, long-term capital gains and qualified dividends get taxed at 20%. And you would not combine these items into the ordinary business income, otherwise you're going to be taxing them at regular rates. So we break it out, report it separately to the partners. Let's take a look at some other separately stated items. Here's a list. For example, portfolio income, subject to something called the net investment income tax. This is a separate tax from the regular income tax that was established to help with Obamacare, the Affordable Care Act. So things like net dividend income, interest income, net rental income are all subject to the net investment income tax. Guaranteed payments is a topic we have not covered yet during the semester, and probably not in any previous tax class. Guaranteed payments are almost like a wage or salary paid to a partner. Keeping in mind, a partner can never be an employee of their own partnership. And this guaranteed payment is in addition to the profit sharing percentage the partner is given. Let's say the partnership is running a loss, but still this payment is guaranteed to that partner. So the partner has to treat this as income. And sometimes people have a hard time visualizing it, but it's also the same payment is also a deduction to the partnership that is shared among all the partners, including the partner that is receiving the guaranteed payment. So we'll see how this amount appears at least two times on a partnership tax return. Once as income to the receiving partner, and as another time as a deduction to the whole partnership. In addition to income taxes, in addition to the net investment income tax, another common tax for self-employed taxpayers is the self-employment tax that we had learned about back in chapter number 1 for a sole proprietor. Sole proprietors are self-employed and they have to pay Medicare and Social Security taxes. That is called self-employment tax. Likewise, partners in a partnership are also considered to be self-employed taxpayers, subject to this self-employment tax. So we have to help these partners calculate the amount of their partnership income that is subject to this tax. Here we report to the taxpayers, the partners, their share of tax-free income. Even though it's tax-free, we still report it to the taxpayer, and they in turn has to report it on their individual return even though it's not subject to tax. More so, the partner has to include this in their cost basis of their partnership interests. So it will increase the basis. So eventually when they start drawing on their partnership account, they can draw it out tax-free. Or if they sell their partnership interest, this amount will be included in the cost basis they can subtract out, reducing the gain they have to report. Investment interest expense, we know that's deductible to the extent of net investment income. That's a topic covered in the first tax course. Charitable contributions, we know that's an itemized deduction for individual partners, subject to, I think it's the 50% or 30% AGI limitation. We've seen this deduction back, I believe, in Chapter 2. Remember the Section 179, first year depreciation. This is not the bonus one now. This is 179. And it's subject to limitations, both here at the partnership level and also the partner level. So again, we need to communicate this information to the partner so they can determine limitations at their level. Let's kind of visualize all of this here. So if you remember, we have just like a corporation, we prepare an income statement where we have revenue minus expenses equaling the partnership's net income or net loss for the year. And typically a corporation would pay taxes on its net income. But remember now, partnerships do not pay taxes. We allocate this net income or net loss to the partners. And again, we're going to separate the revenue and the expenses between two different groups. One called ordinary business income or loss. Would like to use the word net, yeah, because that's really subtracting revenue minus expenses, ordinary net business income or loss. So most of your operating revenue would go over here. Most of your operating expenses would go over here. Subtracting the expenses from the revenue gives us that ordinary net business income. Now the other revenues that aren't in this middle column is the separately stated items. Sorry for my bad penmanship here. Okay, so things like that capital gains, the tax exempt income, the dividends, qualified and ordinary. Also stuff like the Section 179 deduction, charitable contributions, penalties, government fines. We know we can't deduct that, but that has to be reported as a separately stated item. So the partner knows that this amount here has to reduce their cost basis in the property. Likewise, the tax-free income, the exempt income, increases the cost basis of the property even though it's not subject to tax. So all of these separately stated items, including the ordinary business income, all of these amounts have to be communicated to the individual partners. So now they can report their share of these amounts on their 1040 form or whatever form they're using as a partner. Here's that term again, guaranteed payments. So think of this as a salary or maybe even a rental payment that's fixed going to that partner, no matter whether the partnership is profitable or not, no matter if this partner that's receiving the guaranteed payment is also receiving a percentage of the partnership profits or losses. Guaranteed payments are treated as ordinary income to the receiving partner. So not just subject to income taxes, but also subject to the self-employment tax. This amount being paid by the partnership to the partners is a deduction to the partnership, an ordinary business deduction subtracted to get that ordinary business income or loss. So again, this guaranteed payment is going to show up at least a couple times on a partnership tax return. Once as a deduction on the first page of the partnership return, and also as income being reported to the receiving partner. We mentioned that self-employment income is also reported as a separately stated item to the partners so they can calculate their own self-employment tax. More and more what you see is businesses are not run as a corporation or even as a legal partnership, but they form as a limited liability company. This is probably the most common business type entity. I think in, was it Chapter 4, I posted up a list of all of the new businesses in Hawaii, and the vast majority is LLCs versus corporations. And for tax purposes, limited liability companies are generally treated as general partnerships, where all the, not partners, but we call them members, are treated as general partners. Okay, so the same rules we've seen throughout this Chapter 9 also apply to members of an LLC. Now, because most businesses form limited liability companies because they want to limit the liability of their owners, there may be restrictions in terms of how much deductions that can be claimed on those members' individual tax returns. Okay, but here we're saying most LLC members are probably going to be treated as general partners. Another tax I mentioned before in the previous slide, that certain types of income are also subject to the net investment income tax. I believe that's a rate of 3.8%. This is for the wealthier taxpayers, again with a range of annual gross income of $200,000 or $300,000. So for reporting purposes, the partnership has to file every year a Form 1065 with the IRS. And for calendar year partnerships, that return is due to the IRS by March 15th. Of course, individual taxpayers have one more month to April 15th to file their individual returns. So the ordinary business income or loss is going to be reported on page 1 of that 1040 form. And the separately stated items are going to be reported on, it's really page 4 of a Schedule K of that same 1065 form. This Schedule K would have all of the partnership's ordinary business income or loss and all of the separately stated items. But to communicate how much of each amount is going to be reported to each partner, for each partner, now the partnership has to prepare a Schedule K1 showing the partner's his or her share of the income and deductions. So here's an example of a 1065 form. This is page 1, reporting the ordinary business income and the ordinary business deductions, and when we subtract the two, we get the ordinary business income or loss amount that we've talked about. Again, this is the main operations of the partnership, the selling of its merchandise and services. Not all of the income is reported here, right? And not all of the deductions reported here. Separately stated items are reported elsewhere. But this ordinary business income or loss amount is going to be reported on a Schedule K, the first line of Schedule K. So let's take a look at that. Page 4, I believe. A Schedule K. And here in the first row is the ordinary business income or loss we saw at the bottom of page 1. And then all the other separately stated income items, all the separately stated deduction items. Here's that self-employment income we talked about that the partners may have to pay Social Security taxes on. Credits could also be separately stated. Remember, this is different from deductions. In addition to taxable income amounts and deductible expense amounts, non-taxable income, non-deductible expenses are also reported here, again to adjust the partner's basis. Income will increase the partner's basis. Deductions will reduce the partner's basis. Okay, and then let's see. Anything else I want to point out here in Schedule K? I don't see. Well, let me zoom in here, especially at the bottom. I can't write here when I zoom in, but on line 19 says distributions. This is the withdrawal of cash by the partner from the partnership. Yeah, could be cash, could be other property. Keeping in mind, when the partner takes money out of the partnership, that's not income to the partner. What's income to the partner is whatever is allocated up here in the income section. When a partner has income, it does not necessarily mean the partner took money out of the partnership. All it does is increase the capital account, the cost basis of that partner's interest in the partnership. Now the partner can take out money tax-free to the extent of their capital account. And taking money out, that's the line 19 here at the bottom of Schedule K. Now all of these amounts here on Schedule K is for all the partners, the total for the whole partnership. Now we're going to be allocating these amounts here on Schedule K to break it down to each partner. So here's an example of a Schedule K1. Here's the name, contact information for the partnership, and here is the name and contact information for the partner. So this column here is pretty much like the column we saw back on the K1, but only for this partner's share of those amounts. If we zoom in here near the bottom of the K1, in section L, you can see a reconciliation of that partner's capital account. The beginning capital plus any contributions the partner had made into the partnership during the year. Increases would be income allocated to the partner. Decreases would be losses allocated, or expenses allocated to the partner. And of course, withdrawals would be the opposite of contributions to end with the ending capital. And as we mentioned in the first video lecture, this ending capital cannot go below 0. Now all of these amounts are the inside basis of the partner's interests. It doesn't include the partner's share of the partnership liabilities that are reported here in section K of this K1. Notice how it breaks it down into non-recourse, meaning that the partner is not personally liable, versus recourse, versus qualified non-recourse. This is something that comes into play when you have passive loss limitation rules being applied. Okay, and even notice down here, this is topics that were mentioned in Chapter 9. if you keep strictly to the numbers we've been talking about, the partnership would be recording things at tax basis. And here's what you would learn in an advanced financial accounting class for partnership: GAAP rules. This section 704B kind of refers back to the valuation of fair market valuation of items versus the cost basis of items. So more like GAAP than the tax basis. Okay. Let's zoom out of this screen here. Let me go back and talk about guaranteed payments. Again, guaranteed payments will show up right. Let's see. Here in line 4. And the partners receiving this amount would report it as income. But this amount is also being deducted back on page 1 over here, okay, as a deduction. So income to the receiving partner, a deduction to the whole partnership, reducing this ordinary business income. And again, the ordinary business income is being reported here in line 1 of Schedule K. So as a partner, you could be receiving a guaranteed payment that you gotta report as income, and part of that guaranteed payment was subtracted from this ordinary income, reducing the amount of overall profit you have to report as a partner in this partnership. We've seen a similar page like this for a corporation, where you have a balance sheet for the current year and last year. We also have, remember that Schedule M1 you had prepared for the project, reconciling the so-called financial statement book income to the partnership taxable income. And then we also reconcile the beginning capital and ending capital, now not for retained earnings, but for the capital accounts for the partners. And when the partner receives their K1 back on their 1040 form, they're going to attach a Schedule E to report their share of the ordinary business income. So here is the name of the partnership. It's a partnership versus an S corporation, which we'll talk about a couple chapters from now, and whether or not we need to calculate the basis computation in case there's distributions in excess of the basis. Remember, cost basis cannot go below 0. And if there's any amounts at risk, meaning there's non-recourse liabilities, we break down the income or loss either as passive or non-passive. So passive or non-passive, that's a rule you probably saw in the previous tax class. Passive losses here can only be deducted to the extent of any passive income. If you have more passive losses than passive income, the excess losses are carried over to future years to offset future years' passive income. And they get suspended until you either get more passive income or you dispose of that passive investment. At that time, you can deduct all of that suspended passive losses. Here you can see a schedule just keeping track of the different passive investments you may have, including a passive investment in a partnership. Active income or non-passive income, if it results in a loss, is deductible against other types of income. They call it active income or portfolio income. There are limitations in the case of losses here, but there's one limitation for passive losses and a couple other limitations for other losses. Okay, so here's an analysis of how you adjust a partner's basis in his or her partnership interests. We start off with that basis we had calculated at the beginning of this chapter when the partnership was first formed, or when a partner buys another partner's interest. And then if the partner makes a contribution, be it cash or other property, to the partnership, that'll increase that partner's basis, increase the partner's capital account. So just the opposite, if a partner takes a distribution or withdrawal from the partnership, that'll reduce the partnership's interest. Now keep in mind that when you take out money, this is not income to the partner. It's a tax-free distribution, recovering any income that was already reported by the partner, recovering any contributions that were made by the partner. Now, another thing that will increase the partner's interest is any income allocated to that partner, be it separately stated or ordinary business income allocated to that partner. Now, this doesn't mean the partner took out money. Here's where the partner takes out, here's where the partner takes out money. So maybe the partner did earn income. Maybe the partner did take out that income as a drawing. Or maybe the partner earned the income but didn't take out the income. They'll keep their basis higher so they can take out more money later on, or have a bigger basis when they sell the property, reducing the gain they have to report. The last item here that decreases is just the opposite of ordinary business income. Here, an ordinary business loss, or separately stated expenses, like that Section 179 deduction. Let's analyze these different situations by using maybe a debit and credit from the viewpoint now of the partnership. So let's have a couple of different columns here, a debit column and a credit column. Again, we're looking at the viewpoint of the partnership and not the partner. So here the partnership is receiving cash from a partner. So of course cash is an asset. We know we increase assets with a debit, so we debit cash. What are you crediting? This is not revenue, right? You're not borrowing money. It's a contribution by a partner. So that partner's capital account has to be increased. This is an equity account. Equity is increased with credits. Likewise, if we have a cash distribution, that means the partnership is paying out cash. Cash credit, decreased asset. So what are we debiting? Possibly we're debiting capital account, or I've seen we even have a withdrawing account for each partner that eventually is closed into the capital account at the end of the year. In either case, equity is being decreased. So how about allocating a partner's share of his or her income, or his or her loss or deduction? So if you remember in your first accounting class, at the end of the year we close out temporary accounts like revenue and expenses into an account called income summary. So revenue was closed out in here. So here is revenue sitting as a credit, and here are the expenses, the deductions, sitting as a debit. Hopefully you have more revenue than expenses, so the balance in here is a credit balance equal to the business's net income. And now this net income is going to be shared among the partners according to their profit or loss sharing percentage. So let's say half of this net income is going to be allocated to our partner here. So we're going to reduce the net income. We're going to be debiting income summary. we're talking about income here. So we're going to be reducing the income summary account and increasing that capital account for that partner for their share of the net income. And then for another partner, we're going to reduce the income summary and increase their share of the capital account, his or her capital account, eventually zeroing out the income summary account. And just the opposite would happen if you have more expenses than revenue. A net loss now would have to be allocated among the partners. Can't find my mouse here. Anyway, reducing the capital account. Yeah, reducing the income summary account. I think that's the other items we have here. Again, using debits and credits. Now, you notice here, allocating net income or loss, there is no cash. You're not making any distributions. Distributions are a separate transaction here. And this cash going to the partner is tax-free as long as the partner has a basis in their partnership interests. And keeping in mind, the capital account is the inside basis. And you can take cash out of your account to the extent of your outside basis that includes that partner's share of the partnership liabilities. Cash distributions in an operating partnership is not taxable income. The partner already reported income on their share of the partnership income, increasing their capital account. So now when the partner gets cash, it's a recovery of their basis, tax-free. Here it says it's a recovery of any previous taxed income that had been credited to their account, or recovery of what they already put in as a capital contribution. Also, what you don't see in the capital account is to the extent that partner has basis for their share of the partnership liabilities. Now, if they receive cash in excess of all of this total outside basis, only then any excess is a gain, probably a capital gain, since the partnership interest to the partner is a capital asset and going to be subject to that lower 0, 15, or 20% tax rate. Last topic. Let's say now we're going to be allocating losses to the partner. We've already talked about limiting passive losses to the extent of passive income, and any excess passive losses get suspended until a future year when that partner receives an allocation of passive income, or when the partnership sells that passive investment, or when the partner sells his or her partnership interest. Only then it releases that suspended passive losses, which may be good because when you sell that passive investment or the partnership interest, you may have a gain, and the suspended losses may offset that gain. Tax basis, the main thing here is that you cannot take losses below the partner's interest in their partnership interest, which is not just the capital account that again cannot go below 0, but also the partner share of partnership liabilities. At risk amounts, this is where economically you will can lose money, and only to that extent you can take a deduction. So even if you're allocated partnership liabilities, the so-called non-recourse liabilities, you cannot take losses against. And again, you have to wait until you have amounts at risk, typically when the partnership turns profitable, or you make more contributions to the partnership, increasing the capital account. Okay, let's stop here. Make sure you work on your Learn Smart practice questions. homework assignment, and only then when you study for the chapter, go ahead and take the Chapter 9 quiz.